Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Friday, November 18th, 2022. I'll be brief. I just went through some of the last few posts and answered some of the questions, and they're good ones. So I figured probably the easiest way is just do a very quick video and tell you what my thoughts were on these updates. So, because I left these out in the last couple videos. First one, somebody asked an update on USO and CL, and basically this is it. So on the USO chart, I said next sell signal come on a solid break below the 67.60 support. You can see on USO, it's the same chart I had. And just an FYI, you can always check on the website under any post. Or you can go in the support page, resources, and there's a search by ticker. But under the post, I will tag a post, the main post, not the replies, not the comments. The main post will have the symbols that I covered in that post. So if you look at, for example, click on USO or CL or WTIC, $WTIC, that'll show you the last post on crude oil. And especially if USO, sometimes I might cover CL and not USO, but there's USO right here. That's the uptrend line that I've been targeting for way back. I think it was all the way back up here. We had a breakdown there and then a breakdown there. We got in this trading range here, and that's a big level to me. That's 67.61 is where I have the line. We'll call it 67.60, and you can see there we need to break that level, and that should bring us down to that final swing target from all the way back up here, which is 58.60 and or the uptrend line here. Let me zoom in. That's just the chart on the site. You can zoom in here. I can do this, scroll. So it's a pretty good level. And we tagged it today. We had a little bounce. Now on that too, you can see up here 69.50, and there's a gap there. That's resistance now. And this is what it looked like on the 60-minute chart. This was good for the last short trade. You can step down to the shorter term time frames, the intraday charts, like a 60-minute, kind of give you, you can see there you had a divergent high that rallied back into resistance. But I also like to use, and I would encourage you, even if you're trading the ETFs, or technically this is an ETN. If you're trading those on crude oil, you should keep an eye on the futures. That's the real deal. That's what the pros typically trade, and it's also trades around the clock, so you have more levels, more reactions to identify, because these are futures contracts. And this was today right here. We had a break of a pretty good support level. That was that one little brief whipsaw. You saw it on USO as well, where we spent a little bit of time down through there, late September into early October, and snapped right back up. And again, so that's that big box trading range I just circled on the daily chart right there. We've been bouncing through. So we took it out today, but you really have, I guess, well, again, you look at the USO chart, you're going to see you have to take out that recent low. And so what I posted on that homepage post, let me go back to that one more time. I also put the chart of CL, crude futures, for you. And, well, I can't zoom. Let me just go to the live chart and show you. That was from earlier today. So the way I see it on CL, I'm going to zoom in a little tighter for you here. Let's take it in. Grab that little doohickey there, the slider. And so here's how I see it. 3 objective shorting levels if we even get there next week. Remember, it's Friday now. These things are going to shut down soon and pick back up Sunday night. Primary trend line off the highs right there. That'd be a pretty aggressive bounce, but certainly doable for crude. I don't see any positive divergence on the 60, so I doubt we're going to get there. We have a minor trend line here that would make an objective short, and it comes in, as I said in that post, that 81.88 support. So there's a really nice level. If you get it next week, you may want to throw a short trade on crude and put a stop somewhat above again, or layer in up to, but not above that downtrend line. But I think that would probably be the most we get, and then we may get that breakdown, and then if so, that should help the energy short trade on the energy sector. That's the energy stocks, XLE, ERY, and the likes. In the questions as well, somebody asked if there's a short one-time inverse for energy stocks. To the best of my knowledge, no. I mentioned, ERY is 2 times short, DIG is 2 times short, and DRIP, which is the oil and gas exploration and production sector, they're all 2-time inverse. I don't know of a one-time. So if it's out there, chime in for member TJS, because it looks like he wants to short inside of an account where he can't use leverage ETFs. So update on gold. Okay, not much to add on gold. Here's the charts. Well, uh, you remember, I told you the other day, I think it was earlier this week, that I closed out my longs and just wanted to short a pullback trade in gold and silver, and that's one of the reasons. This is a 60-minute chart of GC gold futures. We had that nice clean uptrend line right there, culminating in this divergent high, negative divergence into a resistance level. Broke down, that was a sell signal. Now we have potential. We closed the week, and I closed out. I closed a lot of stuff out today. I told you guys I was going to lighten up on index shorts. I took a very mild, for me, it's a very mild position of just a few contracts NQ home, but nothing heavy, and just a few of RTY. I think 3 of NQ, 5 of RTY, and I'll wait and see how we open next week. The downtrend line right here, or potential divergence line, I should call it, on GC gold futures. Remember what happened to gold recently. So this is a relatively minor pullback based on the scope of this whole move up and the wedge and all that and the divergence. But when when you have a very bullish development on the daily chart, I'm not looking for a deep pullback. Now you can get it. I'll welcome it. I'll be a buyer here. I just went flat. Closed out those GC and SI silver short trades today before I went home. I kind of wanted to clear my plate, if you will, for the weekend and just come home pretty light, and then see what happens on Monday. If the market pops up, I'll decide whether to add to the index shorts or close them out, depending on what I see. It was almost, believe me, it's almost like going on flat unless there's a big move, and I'll have some stop losses in place. So the only way I get hurt on that position is if there's a huge gap up on the futures on Sunday evening. And again, I have enough not to hurt me too bad. So that is the futures of gold. And then here, let me go to the live chart. And again, you can reference these posts. This was under this post here, XLE and ERY price target updates from this morning. But let me give you that gold chart real quick, and then we'll look at the dollar, and that all plays in, and then I'll get to Treasury bonds because I had a question there as well. So this was gold on I just happened to be on the 60-minute time frame. There was the downtrend line on GLD, the gold ETF. Beautiful, well-defined downtrend line. That's what I say, beautiful, well-defined. Lots of clean reactions. I didn't draw my blue line exactly on where the white line already was, and there's your breakout, and that's the initial leg up. So this is 110% bullish. That's what you want to see in a breakout. You want to see impulsive action, a little spike in volume. Nothing goes up forever, and again we had the divergence on the futures as I showed you a little, and that's the same uptrend line. You just see, here's why I recommend that you keep an eye on the futures, even if you only trade ETFs. You didn't really have negative divergence here on the 60-minute chart, maybe the slightest little tidbit at the end there, but you could see it better on gold futures because this is only showing you 9:30 p.m. to 4 p.m. trades, and the futures are trading almost around the clock there. So that's that. But the bigger picture is, and this is what I posted on there. Okay, if we pull back a little bit more next week, you have some pretty good support coming in. Remember this, my buy zone range all the way down here, but this was just a support line in the middle of it, a support level. It was, you can see it's 161.31. We had it was support. We hit it again, bounced after that drop for 3 days. There's 3 candles after 2 after the big red one down there. There's more reactions on it back here, and you zoom in more recently. So it's a level that has gold has acted on, and it was support. They broke it and then hit the bottom of the trading range buy zone, just like you did there. You bounced up and right back to it, bounce into resistance. So I'm showing you here, what to me makes a support level valid. So you got rejected there, you ran at it again, got rejected there, now you took it out. Oh, I'm sorry, this is, yeah, that's it, same level, I'm correct. Carry over here, and this is it. So you get a pull back to that 161.30-ish right there, and I wouldn't try to be a hero and clip in at 161.31. I'd be a buyer a little bit above that, and I'd also allow even more downside if they overshoot it, because you have a big old gap to potentially be backfilled. Caps usually are tested at least. and quite often backfilled. So this is the gap right here. There's the bottom of the gap, and I'm just drawing that arrow out. So right here to here, that's what I drew for you there. Would be a nice objective entry. If we come all the way down to 158, I'd still be a buyer. I really don't want to see 158 go. It's just going to muddle up the bullish picture. But everything that happened recently, including but not limited to the positive divergence, the false breakdown, and then the bullish recovery back above 158, puts me longer term bullish. Therefore, I'm more apt, if I do what I did and take profits to game a pullback, it's going to be relatively brief. I'm not going to go for a moonshot on a pullback trade immediately following bullish price action. I'd rather get in a little early, get back into my longs a little early, than miss the turn in the next leg up. Those are my thoughts. And then it all has to do too with the euro and the dollar, and this is USD. Remember, on the weekly chart, we've rallied back to a major resistance level, which is this long term. This is a weekly chart. In this zone, these two purple lines, which I'm boxing in here, we ran up almost at the top of it and closed the week right on the bottom of it. So far, this is capping. Remember, that was all these lows for going back for years. This one goes back to early 2015 right there. Early 2017, late 2016, early 2020 COVID lows, and most recently there. So pretty significant resistance. And if they happen to take it out, you still have a very significant downtrend line as well to contend with. So I think for the very near term, the upside's probably limited in the euro. Maybe we consolidate, and either way, that's going to put a little bit of a headwind for gold. Gold, ultimately we need to break that out to see the next big leg up in gold, and when this happens, when we clear this downtrend line on the top of that resistance zone right here at about 1.05234, give or take, plus the trend line's a little bit above it, that should open the door, and this would be the next major advance in gold that'll probably take gold up to the previous all-time highs and maybe beyond. So that's what we're looking at. But near term, it's probably going to be a little tough sledding for a while. So that's my guess. And then when you jump down off the weekly, you get, here's the daily chart. We got quite a bit overbought. There's still, we could go up a little bit more, and we do. That's going to be bullish for gold near term, because gold tends to move up and down with the euro, which goes opposite or inverse to the dollar. Should we get a deeper correction? Well, you have really good support here. Price support at 1.00893, and then the uptrend line as well. So near term it's a little bit unclear, but then you step it down even farther, and you have this. Remember, gold moves up. This big thrust in gold we just had coincided, not by coincidence, but it coincided with the rally up in the euro, which is a drop in the dollar, but the euro put in a divergent high on the 60-minute chart, and really it's played out for a correction mostly in time so far. From the divergent high, we kind of consolidated around, but if we drop below this 1.02909 level, you're probably going to come back in a little farther here, and that could put that additional downward pressure on gold. So if you see this next week, the euro pop, go down a little more, and I think that's what I favor, a little more downside in gold, then step in, be a buyer here all the way down to this trend line like that. And then remember, I use the euro, it's inverse to the dollar, but you can also track dollar futures, and that is symbol DX, and that is, I've got a chart for you I wanted to share if I can find it. DX, where'd you go? Where are you hiding? Here it is. DX, US dollar index futures. We're on a 60-minute chart, 3 months of price history, hourly candles, and just like the euro, just recently your euro-US dollar pair put in a negative divergence or divergent high. You put in a positive, aka bullish divergent low on the dollar. The dollar has already had its biggest correction in years, or at least in quite some time. So that was a catalyst for that thrust up in gold. Gold trades inverse to the dollar. If the dollar is dropping, it takes more dollars to buy an ounce of gold. That's why the price goes up. It's not magic. And so therefore, if this happens now, the dollar's been falling, but if the dollar breaks out right here above 107.135, which it looks to me may likely do that. I'm not positive, but like my convictions aren't super high. That's why I'm going home flat over the weekend. There's also a little uptrend line there, and we could break that and go down and then put in a rally, hit that last leg up in the euro I was showing you about, and we could have even a bigger divergent high and set the stage for a rally at a little bit lower levels in the dollar. So if I had stronger convictions, I'd be positioned one way or the other. I'll wait and see how this plays out next week. But like I said, there's a good chance, and especially if we pop 107.135, dollar's probably going to run up here to 109.091 right there, and that would give us that last little bit more downside I was showing you on gold for next week, and give us a buy point there with probably a pullback at that point in the dollar. Here's some pretty significant uptrend line or downtrend line. If the dollar happens to continue higher, that's another area we look for a pullback in the dollar. Again, that's DX US dollar futures. And I haven't updated Treasuries either because there's really no update since I gave you the last one earlier this week. It was that Wednesday. We popped up to that 100.63 resistance. It's pretty significant right there. It's not huge, but it's the first resistance we've had in a while. So longer intermediate term, it still looks constructive. I still maintain this next target here about 107.96. I think that might be my max target. Says max potential target. Right now, this may be where I close out. I have also, this is something else I've closed out. No positions in Treasuries right now. Going home flat on the weekend. Not sure. We're coming off pretty nice positive divergent low, and TYX, the yields broke out and everything I wanted to see. So I had all my buy signals I've been waiting for in Treasury. So I'm bullish, and I'd rather look to buy if we can get a pullback a little bit more. Love to see a pullback to 97.92, and near term thinking we might get that. We could even get another leg down to new lows. So I'm not I'm just, I told you what I'm doing. I kind of lightened up. I'm going to pick it up next week and kind of reset, let the market kind of show me where it wants to go next week. And then remember, okay, that's next week. Next week is Thanksgiving holiday, and so we have the market closed one day full, and I think another half day if I'm not mistaken. So you get a holiday week. Trading volumes plummet because most traders are going away. I'll be going out of town. A lot of people do. And then right after that, coming back in, you're going to have the Fed meeting on the 12th, and I think the announcement's on the 13th. They meet the 12th and 13th if I'm not mistaken. So what I'm trying to tell you, it's a great time. Go out, do some shopping, spend time with family, actively trade. 5-minute charts, 10-minute charts, work like a dream still. But as far as all this stuff, hard to say where we go next week. All I can tell you, if we pull back there, that's support. If the shorter term charts provide a signal, maybe step in there. Otherwise, we could be flagging here. We could break out. That we had an impulsive leg up. Draw up for you here. Impulsive leg up, maybe a little flagging, and we head up there. I just don't see, with the big Fed meeting coming up in a few weeks, I don't see a big movement happening in Treasuries. It's possible. Maybe you get a little short covering going up there, but again, you can hear my voice. If I had stronger convictions, I'd tell you. But intermediate, I still think whether we go down for a while here in the short term, in the next coming days to weeks, even make a test or make a new low, I still think Treasuries are coming back up here at least that 108 level. So 401k type stuff, I think it's still a hold for now. Plus, remember, Treasuries, and it's not a whole lot, but you're collecting interest. If you sit in a sideways trade for gold for an extended period of time, there's not any income being spun off. So at least Treasuries, 401k, if you went nowhere for the next 6 months, you're getting a little bit of interest kicked out off the Treasury bonds. And then as I mentioned, TYX, the 30-year yield, that was our buy signal right there. And so talked about it forever and a day, and then we finally got it, and it came with a bang as expected, and it's been nothing but a drop in yields as predicted. And we're close to, but not all the way to these. I have BOD. I have two trend lines coming off the same point. There's the first one, and then my BOD, or benefit of the doubt, comes in a hair lower. That's probably the one I'd favor. So we'll probably work our way down there, and if we get there, then we'll get a bounce in yields, which means Treasury's down. So we'll have to watch this chart as well. But ultimately, I think we work our way down. We'll take that trend line out and head on down here. And we could head on right through it. This has been a crowded one-sided trade at some point, and I think the Fed was already planning. I believe they had accelerated the quantitative tightening already this year from originally planned, which means they could end sooner than originally anticipated next year. I'll have to look into that. I remember March or something. I thought I might have heard, but don't hold me to that. But yeah, when the market starts to anticipate that the Fed's going to be finished or close to finished with quantitative tightening, you're going to see, I think, a nice rush into Treasury bonds because inflation, we'll probably see it abate. I think we're still in a longer term inflationary environment, but there's going to be periods of abatement in inflation where it cools down a little bit, and it also may moderate instead of continuing to push 8% inflation. That would just be crippling. I think we'll come down, but we're still not going to go down to the 2% or so the Fed wants. So even if we're in a 4 or 5% inflationary environment, it makes Treasuries start to look a little more attractive. When they're paying about what the rate of inflation is. If the yield's still about 4% or so on the 30-year here, and then TNX is a 10-year. Let me just mention that real quick. There's our minor trend line break. It was just nice, beautiful trend line. There's a sell signal. So the 10-year yield will probably continue to drift lower. I very much believe that. And if it does, that means the 10-year bond is going to continue to rise. Here's your support levels. Remember, this is the opposite of the bonds. This is their yield. So if it drops, that should be more upside in the 10-year Treasury bond, which is IEF. If you trade the ETFs, or ZN if you trade futures. There's the next level there. I didn't mean to have that bounce go up that high. Probably take that out. And then here it is, IEF. IEF, that's just a beautiful little breakout. That's the weekly chart I was on. Sorry, I was messing you up there. There's a daily chart, but the reason, again, I pointed out the other day, we had the 30-year hit resistance, and IEF almost hit that resistance there, but you're better off going on the yield. Than in my opinion, than the actual, especially in ETF. So the yield is very close to that support level, those trend lines there. And then ZB, I think I already showed you. No, I didn't show you ZB. Well, I showed you the other day. We hit the 125, 238 resistance, got checked there, and we had negative divergence. So this is why I can see, unless we're going to go up and extend that divergence as possible, but right now this says, you know what? You get these 60-minute divergences. You have dual trend lines here. I have a minor trend line. Here, let me tighten it up for you. And a minor trend line right here. And a more significant longer-term trend line right here off the November 8th low right there. And negative divergence. So if this puppy cracks next week, meaning both those trend lines, you're probably coming back to at least that 123.315 level, and quite likely these were near-term targets right here, T1, T2, and T3. That's a likely pullback target. T3, which is about 122.260 up to 123.054. So that's my near-term outlook. That's especially if the sell signal is triggered, you're likely to see a little more downside in bonds, and then I'd be a buyer here, step in and go long at that point. And then I'm going to show you the 10-year, and then I'll move on. 10-year, this is a 60-minute chart of the futures of ZN, the 10-year Treasury bond. There's a nice textbook bearish rising wedge. There's your breakdown. There's support. So I don't see, this really much holding this thing up until we come down a little bit more to 11,268 right there on the 10-year, and that'd be a minimum target. But remember this whole thing. So here's how I analyze charts. Here's how I trade. This is a longer-term trend line. It even goes back there. This was the breakout that coincided with the breakout in yields. Far from coincidental. I talked about this every day for weeks. We got the breakdown on the yields, and I told you the 10-year broke down first, but it took the 30-year. I told you we'd have to see the 30-year breakdown in yield also, the TYX 30-year yield and TLT breakout. And when they did, so the 10-year broke out first, but it was kind of held back for traders waiting to see the long bond go, and then it just ripped when the long bond broke out. So that was the powerful breakout. So point is, this is a powerful, powerful breakout, and therefore, although in a vacuum, if I didn't know about all this or see all that, I'd say, oh, here's the 60-minute bearish rising wedge. I'm going to take the measured part of the measured target, which is the widest part of the wedge. I'm going to add that to where the wedge breaks down, and that's my pullback target. Now that could certainly be hit, and there's support just below there, but on the heels of a powerful breakout, as I said earlier, with gold and all that, I don't want to go for the moonshot, pullback short trade on this. I'd rather get in early, cover any shorts early, and get back in long, because I don't think this wedge is going to play out for much more than it dropped it down to these levels right here, most likely. So that's my near-term outlook for Treasuries. Most likely a little more downside early next week, and then maybe that could be the end of the correction. Or again, Fed's coming up on the 12th and 13th, so hard to say. Okay, I had a brief interruption there, but let me just wrap this video up with a quick update on the market. Again, the market grinds around, and it's been doing that, and it will probably continue, maybe to a little bit larger extent leading up to the FOMC meeting. This is still a pretty significant level, I believe, 284, about 284.38. We popped it, we went under it, we're back above it, but for all intents and purposes, we're just grinding around it. So the market is still, it picked a direction, at least from this, FOMC meeting here, that direction was up, made a new higher low, and so far a higher high. So at this point in time, you have all the makings of an uptrend. You're coming off the divergent low, but you guys know my thoughts. I'm not here to do the long-term analysis. I've already told you. I believe the most likely scenario is still whether we get any more upside into that bounce zone or not. We're probably going to take out the lows. And we parked right on that level today. Told you, took a little bit of mild short position home, which just felt like it was almost a coin toss. But it comes back to these 5-minute charts, and this is the one I shared earlier. I didn't leave my desk today, so I traded. I did, as I think I told you, covered that here, the short from coming into the day, sold it right there. That first was as I was doing the video, but then told you earlier I was going to be targeting there. And then on the pullback, it still looked constructive. I looked at SPY, IWM, RTY, everything else. A lot of others were at support with 5-minute divergences. So recycled back in, swung it up there, and hit that 11,705 target. And then even reverse that. But that's again, these are just need little act trades. You only need if you're swinging 10, 20, 30 contracts NQ plus that many of RTY, a quarter point's going to make your day. If you can do that 3-4 times a day, 0.5% all the better. And sometimes you get a 1% plus swings out of these intradays. But that's it. These are all the same levels that are on the chart, and you can see if you look closely, that's where each one of these little tags, you get a pullback. That's I see them, and I guess everyone else in the algo see them. And it's just my point is it's very conducive to active trading right now. Look at that. That was at 11,743.51 to the button. That was the high right there, and boom. That was the last ones I wanted to put on for the weekend to come home with. So believe me, they're hardly anywhere much below where they were before at the just before the close today. So that was the final drift right there. Somehow I changed this away from candlestick. There it is. These are candlesticks. So boom, boom, boom. All right, so we'll see next week. But now the next week and all that goes back to the bigger picture, really. The 5-minute charts kind of don't end up playing now, because then the trading's going to resume. It's going to shut down today and then pick back up Sunday evening. And so again, this is what I'm looking at. We're at the bottom, bigger picture of the well, that was the bottom of the bounce zone on QQQ. Max or likely bear market rally, and this was also a big level for me here, 11,785. So we're kind of grinding around. We're still coming off that 60-minute divergent high, and we do not have. I usually like to see to kind of change my trend bias on a 60-minute chart. I like these divergent lows to start going to a more of a bullish bias, buying pullbacks and then looking for the next leg up, divergent low. And this was a divergent high right here, and we haven't yet put in a divergent low on the 60-minute chart. So that's leads me to believe we can maybe still still work our way down, potentially back test this trend line, maybe get a little nervous selling. If we do, we start moving lower, it's going to be a surprise for, like I said, most of the pundits that I'm listening to now are bullish, talking about the year end, the Santa rally. And of course, if nothing else, when you rally for a few weeks and you're up, 10% plus, that's when the bulls come out of the woodwork. And so I'm just saying that if we start to move lower, it's going to catch a lot by surprise. You're probably going to see a lot of stops get hit and a little nervousness, again, leading into the Fed meeting. So that's the way I'm leaning right now, but I'm not married to that scenario at all. ES, let me show you ES and SPY, and we'll wrap this up. And I want to show the small caps as well. 1 second. Here we go. ES. That's a 5-minute chart. Here you can see same thing. 5 minutes. You look for these little divergent lows, divergent highs, divergent high, little trend line break, correction down to a divergent low, which is also right there. There's a smaller divergent low right there, and that was actually at the divergent low. Popped up, rallied up. We took out this. That was resistance. And that was a rally right into, this was dual resistance right before the close. So that's where my final, close out, final longs or reverse or put on shorts. I can't even remember now if I was long heading on that last pop in. I had about 6 in and outs in the Qs today. But again, that's 5-minute chart. I know that's not for everybody. Most folks are trading on the longer term time frame, 60-minute chart. Same thing. SPY put in the divergent high. I already went over all the fibs that were hit on the indexes, so many sectors, bearish PPO crossovers. Remember, that all plays to why I decided to take a little short interest. All those sectors that are poised, most of them haven't had that bearish PPO crossovers yet, but a lot have hit and bounced off some key fib levels this week, or still right around or on those levels or just below. And then the PPOs, some of them have made bearish PPO crossovers, and others it's still pending. And then RTY, and then we'll wrap up. So this is the small cap futures, Russell 2000. Again, just like QQQ and SPY, you put in the divergent highs recently on the 60-minute chart, and then you broke the little uptrend line, and it's zigzagging lower. This was a trend line that was violated, just like QQQ and ES, but I mentioned I'm okay with that. That was just a little whipsaw down around those last inflation data, the CPI report, and we're below that trend line. That puts us on a fairly bearish technical posture, but you can see here, again, these are good for bouncing. There was a pullback trade to be made and cover a short, bounce it off that 1825 support right there, and then ride it up and then reverse, short the back test of the trend line right there. And if you trade IWM instead, and that's the ETF for the Russell 2000. Let's see here. You've got there it is. Remember, big picture kind of stuff here. I've jumped all the way out to a more significant daily time frame. There's our primary bear market downtrend line. That means from the all-time highs right there in the NASDAQ. In the Russell 2000. Back in November when the NASDAQ 100 peaked. We rallied up then, and we just hit it again. So 3 reactions off there so far, and and also the 200-day moving averages in that 190.40 price resistance. So all this is an objective shorting level for the small caps. If they're going to take another leg down the bear market, this is a likely stopping point. If they take this out, well, you still have that previous reaction high, and then you have even bigger resistance at 208.48. So call that my max upside target. Much more than that, probably take us to new highs. But this is the way I'm leaning. And again, in a bear market, you can try to get cute and hold out for every last bit of a rally, but that sometimes can cost you an entry of getting back in. Because one day, if we just wake up to a big gap down tomorrow, what happens is those that were holding out for a little bit more, they don't want to short a 3-4% gap down, and so they're going to miss it, waiting for the bounce back or the gap backfill, which sometimes just never comes. That's the signature of a bear market, and we haven't seen that yet. That's one of several components lacking so far in this bear market. By almost all metrics, we're in a bear market, but the one thing I haven't seen is that final wave or that really comes about in the middle of the bear towards the later end, that very impulsive, relentless selling, big gaps down, futures tanking down overnight and gapping down, and then the market's still going down from there. Sometimes, futures trading halts in the stock market, or lock limit down in the futures overnight, things like that. So we haven't seen really that capitulation panic type selling. I've talked about it all along. It's been, we've had some nice down days, but for overall, it's been a pretty orderly sell-off and bear market yet, and that's the one thing missing. It's not. You're usually going to get that, and so my point is, it can come out of anywhere, or it can come, but come much later. It may come next year, but again, the risks are higher. That's all you can do, is just kind of play the odds. It's like Vegas or anything else, whatever you're doing. Even in life, every time you get in the car and turn the key, you have a chance. You could be in an accident. Drink a couple beers, you're increasing the odds of that. So things like that. You can, everything in life. It's, if you think about it, you're calculating odds and possible outcomes. And this is it. This is an objective area to short. And if it doesn't work out, you might not want to ride it all the way up here to 208.48. You could stop out somewhere there next week again, and that's in a vacuum. If I'm trading IWM or the small caps and they break out, above this all this confluence of resistance right here. Well, what's the S&P 500 and the Nasdaq 100 doing at that very moment? Are they running into resistance, which they may get rejected off of? Because I've seen that a lot as well. I've seen one index break out, and then the rest of the big indexes, the other ones, get rejected off resistance, and then the breakout on the one that broke out fails. So that's why I spend all this time talking about so many things instead of just saying, here's QQQ, that's all I trade. Let's just look at that chart. All right, guys, I'm going to wrap it up here and get on with my weekend. This has been Randy Finney with Right Side of the Chart. Have a good one.